Let's put Q3, looking ahead to Q4, and put all those moving pieces together. At the epicenter of pretty much everything has been this massive move in core government bonds. You saw what BTPs have done over the last 3 months, a move of more than 100 basis points, yields lower. What's your base case for treasuries at the moment?
Yields pushing a little bit lower, and that is assuming that there is nothing more than a truce on the trade side. I think you see yields actually push a little bit lower. But if you get even the slightest bit of optimism that we get any sort of trade deal, it could happen. Optimism comes in November and the deal doesn't come until March. You're going to see yields pushing higher. Right now, I'd say look for about a 190 on the 10-year as a peak, absent a deal, and we could go as low as 150 before the end of the year if there's no deal.
That's some big potential swings, and Patrick, the risks run both ways. I get a lot of people around this table jittery, not about the downside risks and just the downside risks, but also the upside risks and not being there in the market to be present for them if they develop. What do you tell people at the moment if they're itching to add just a little bit of cyclicality? They're sitting at the screens and saying, we've been doing this now for the best part of 12 months and change in the global economy. Surely we work our way through this.
I think to Tom's point, I mean, the 10-year is absolutely what we're following here. And if you were to get a bounce in the 10-year, cyclicality is going to work. But absent that bounce, and we're in agreement, we don't think we're going to see that bounce in the 10-year. We think we're lower from here. GDP expectations for 2020 are again lower next year. Against that environment, people are going to continue to look for low volatility, safety, security, and growth. Those characteristics are not value, they're not cyclicality.
Your call, Kathleen, stick with consumer staples.
I do think we should stick with consumer staples. And also I would say, too, to both of these gentlemen's points, one is we don't want our clients chasing yields. It's a very dangerous time right now to chase yields. You can actually get a pretty nice dividend in some of these value stocks. And I would say also, we're looking at companies that have paid dividends consistently over the last 10 years plus and have also increased their dividend payout. So if you have a long-term time horizon, the money that is invested in the markets, do a little bit of a cleanup and point your portfolio towards more long-term thinking.
Does that resonate with you, Patrick?
It does, and to Kathleen's point on dividend yields, and when you look at some of these names now, you know, the top 50 companies, S&P 500, and that's sort of taking out this idea that they can't make their dividend payments going forward, the dividend yield on those names is 4.8%. So the opportunity is absolutely there to substitute yield in your equity portfolio versus yield from a fixed income portfolio.
Looking at the fixed income portfolio, your call, your conviction call, investment grade, US credit, the place to be. Why is that the place to be, Tom?
Well, a couple of reasons. One, we don't see a recession coming in, certainly before the end of this year or even within the next 12 months, which means that you've got an investment grade. For most of the investment grade space, you've got free cash flows, which are more than adequate to service debt. Secondly, almost certainly you're going to get additional liquidity from global central banks. And when that wall of money looks for a place to go, its long-term preferred habitat, oddly enough, is not U.S. Treasuries. It's actually investment-grade U.S. corporates. So you get this wall of money coming into the U.S. investment-grade corporate market that is more or less a flood if you have nominal growth above recessionary levels, but not too high.
Are you competing with the very same capital that Patrick is talking about in the equity market on the income side?
I think so, but I think there's just so much capital coming in. I think it's at this point in time, we're not worried about scarcity of it.
What do you make of that, Patrick?
Well, I mean, I think just taking a step back, there's opportunities in both. And I think for people who say equities are overvalued, we completely disagree. And I think going back to Tom's point on free cash flow, when you look at the free cash flow that these large cap U.S. companies are generating, it has doubled in the past decade. So when you take a step back and say, I don't want to look at a PE, but I want to look at a price to free cash flow yield, we are trading 20 to 30% below long-term average.
You've made this point a couple of times on this program. For our audience that haven't followed it, walk us through why that metric is so important and will be so important in the months to come.
Yeah, so investors commonly look at a PE because it's simpler to calculate and it's relatively ubiquitous across how we look at stocks. But it only captures part of the story. Imagine looking at a book and all you see is the cover and that's your PE, but you don't get into the book. So when you get in the book, you look at how they're running their balance sheet, you look at how they're managing their cash, you see a more complete picture, a more complete story of the company. That is quite favorable when you look at it from that perspective.
Final word on all of this, Kathleen, your thoughts?
My thoughts are to have a long-term view, to not panic, not take your money out of the market, just position yourself wisely, take a little bit maybe out of international and emerging markets. We're reducing a little bit there, but just long-term view, hold your money in and wait it through.